Hello friends, how are you all? And once again, I Pivotnandi welcome you all my this YouTube channel. And as you know, today the topic is very interesting. I have taken one very interesting topic, which is has always been very interesting among you all. So let us just come back on the topic. And like we have taken a topic like why to invest in India and why we should start as early as possible. So you can see I've taken this Excel sheet which I have made for you all to make you more clearer view for the investment, how long one should go on an investment. And so you can see like I've taken three examples. One is this Dow Jones, and for more clarity I'll share like we have got our two exchanges. Just come on the, like you can see there are two exchanges in our equity markets. One is Nifty 50, which represents the largest 50 companies of the market. You can see here 50 is a benchmark Indian stock market indexes that represents the 50 largest Indian companies on the stock exchange. Whereas similarly for Sensex, we have got Bombay Stock Exchange. If you will see the BSC Sensex index, it is a most largest 30 companies on the basis of market cap. So these are the two exchanges where we do invest in the largest companies of Indian market. So let us come back on our Excel sheet. So why do I have been taking these two indexes? Because ultimately we are going to invest in all companies, and directly or indirectly. So my way of investing is to invest in a largest company of Indian economy. So that is why I've taken this. And second, so as I chosen topic is why to invest in India. So whenever we go to invest in our, like for our long term goals, but one biggest question which arises in our mind, biggest question is how long one should be remain invested. What is the long term definition? Long term definition is, what is the long term definition? So for someone it may be 1 year, for someone it may be 2 year, for someone it may be 3 year. But by making this Excel sheet, I will statistically prove, like not going to prove, but I will show how the historically market has been rewarded the investors in a long run of the period, and how you can uh, come out with your understanding after the end of this representation, like what should be your thought process before going to invest, and how should be your strategy, how much long term investment per thought process should be in your mind. So that is why I've come up with this Excel sheet. So you can see here the data column is represented by five column. One is date. If somebody is investing from 95 or to till 22, or somebody has started from 2007 to, so that I will make more clearer. Second is the closing price. What is the closing price? Closing price is like here it is shown like it is Dow Jones US 30. As I already represented, it we in Indian market are having two indexes. Like one is Nifty, which is represented by National Stock Exchange. Second is Sensex, which is represented by Bombay Stock Exchange. But in US there are two three main indexes. One is Dow Jones, second is S&P, and third also the Nasdaq is also there. So for case study purpose, I have taken three case studies like US 30, S&P, and lastly I'll share how Nifty has given investment returns in long terms. So for more clarity, I'll go here and I'll share you one thing, US 30. So why do I'm sharing it? Just give me a minute. Time. as you can see the close, I'll I just want to make it clear ki how the closing prices have been written here. You can see the prices are been written with a 1 year gap difference. You can see the first column represents the 1st January 95 closing price of Dow Jones US 30. Second column in the date is sharing like once for the 1st January 96 what was the closing price of Dow Jones US 30. Similar so on so forth. It has been represented here up till this YTD of December. Today is a December 25th, though it is a holiday. So for this is a work. These dates are being represented for the only working days when the market and index was open. So let us come on the index and what I wanna share you. You can see this Dow Jones Industrial Average Index, and the pricing is being taken from here this chart. This is a 12-month candle basis chart which I am sharing you. If you will see, just look at my cursor. If you will see, you will find here some of numbers which are representing. If you will see here, O is open, O represents open, H represents high, L represents low, and C represents close. But only you have to focus on the C closing price because I have taken in this Excel sheet this closing price. So for more clarity, I'm just sharing you here. And like if you'll see for the, you can see here 2nd of January 95, this represents the whole 1 year candle. If you'll see, once you will put the cursor here, you'll find the closing price here. What was the closing price for 95? So just see, closing price was 5,117. And that is what I have written here. Similarly, for the next year, what was the closing price? You can see 6,448. For the third year, it was 7,908. So you can see in this Excel, like 6,448, 7,900, and so on and so forth. I have taken these prices up till December 23. You can see the last pricing which is being written here, 37,385, which is being represented here. So the main crux of this in presentation is going to be based on the calculation, because I just want to share you how long-term investment in terms of rolling returns or in terms of absolute one from first to inception of the index to up till December, how the investment has yielded in terms of compound annual growth rate. So this next 10 15 minutes would be given more weightage from your side to understand how the interest rate has derived in the better investments. So just come on the third column. Here it represents the year. For year, what does it mean by year? Like someone invested in 95 at the index price, which was at 5,117, and the first year was known as the zero year because you have started your investment and you remain invested for 1 year at the price of 6,448 closing at the 96, like first of January 96. So it closed the 1 year index level. So how much return you are going to get? It is almost a compounded annual growth rate of 26%. Similarly, if you'll come on the next chart, here I have represented the rolling returns, how the returns have been given returns on your investment on the basis of 1 year difference, with the difference of 3 year, with the difference of 5, 8, 10, and 14, so and so forth. You can take out from your side too by your doing your own calculation. So first column is the absolute basis, like one has invested from 95 in the year 95 and has been invested at the index mark of 5,117 and remain invested for the end of or the next year's beginning of the level, that is 6,448. So someone has yielded 26% return in Dow Jones. So you must be thought in a thought process ki why do I'm sharing the first Dow Jones, why not Nifty? So I'll come on this Nifty part because this definitely is the index of Indian market. So for case study purpose, I am sharing you first how Dow Jones has given the good returns in terms of investment. And also I will share ki how comparatively Dow Jones or a US market has given returns in terms of Indian market. So let us concentrate here and understand how I am deriving the value of 1, 3, and 5 years differences. How someone has invested for 1 or 3 year or 5 year or 8 year. So just understand this calculation. For understanding this next column where rolling returns are being taken, for example, if someone has invested in the inception of January 96 at the when index was at 6,448, and he has been remain invested for 1 year when the value was 7,908. So what was the end of year uh, percentage compounded annual growth for that person who has been invested for 1 year of period? So obviously it is 23. At same time, one person who has invested in 95 and remain invested up till 97, for him it will be 24 percent return. So don't get confused by like what is 26, 23. It is only sharing here in this 1 year column. I am sharing ki like if someone is invested in 96 and he has been remain invested in 97, so difference in rolling returns is 23%. Whereas in the first column of compounded annual growth rate, here what does it mean by like someone invested in 95 and remain invested for 2 year of period, which is denoted by 2 year, and he has been getting a 24% return, and so on for so far. For more clarity, let us come on this. Like if some when there was 2008 Lehman Brothers crash, and someone invested at the index when Dow Jones US 30 was at 13,264 level, and he has invested for 1 year period only. So in the year first like 2008 1st of January, someone started his SIPs in the index like Dow Jones, and he remained invested up till January 09, like 2009 he was invested. So you can see like the Dow Jones was at 13,264 level, and at the inception of January 2009 index was at 8,776. So how much with the difference of 1 year investment somebody has got the returns in terms of rolling returns. So he has yielded a minus 34% returns. But at same time, suppose if someone has invested in the year 2009 and remain invested up till 2010 for 1 year period, he has the next person who has invested in the year two in inception of year 2009 and come out at the inception of year 2010. So he has yielded 19% return. So so on so forth. You can see ki like if someone invested in the year of like COVID fall, like when there was January to 2020, and in 2021 he is coming out, so he is getting a at when he was invested, the index was at 30,000 and almost 30,000, and 21 it was at 36,000. So he has yielded a 19% return. So here in this column, my only motto is to understand, make you understand if somebody is investing for the only 1 year. So how the returns have been come. So let us come on the next column. When a person invested for the 3 year rolling returns time. For example, like if someone has invested in year 95 at the index value of 5,117, and he remain invested for 3 years. So he has got the returns of like 80% returns in the Dow Jones in terms of absolute 3 years rolling return. Like he has invested at the 5,000 value, and he was remain invested for 3 years when the index was at 9,201. So what was the return? It was like 80% return. Let us come down and see how the returns have been. If somebody has invested in the year 2008 at the index value of 13,264, so after 3 years, what will be the value? So one, two, three. So you can see like if somebody invested in 2008, so he is going to at the index value of 13,264, and at the end of 3 year, and the index is at 11,577. So someone at the end of 3 years has only yielded a minus 13% return, whereas someone who has invested in year 2009 and remain invested for 3 years, so for next at the end of next 3 years, that person is getting a 39% return. So, so and so forth, you can see. Like if somebody invested in 2018 or say 2020, because there was a COVID period when the index was at 30,000. Dow Jones US index, and he remain invested for 3 years. So after 3 years, one, two, three. So what will be the 3 year returns for him? So obviously, because he has invested in year 2020. So when index was 30,600, and so today at the end of December, this value is around 37,385. So someone has invested. So at the value of 30,000 index value, so that is that the person is getting only 22% return. So and so forth. We'll understand how the 5 year calculation are been deriving, how the 8 years. So let us see if someone invested at the index value of 5,000 when the index was at 1st of January 1995 at the value of 5,170. So he remained invested for 8 years. So he is getting a return of 100% return because the index was at 5,000, and at the end of like 10-year value, the index was just double position. So that is why 100% returns are being marked. Suppose someone invested at the like in 2008 when the we know ki 2008-9 was the Lehman Brothers crash time and market was very cheap and very low position. So if somebody invested looking at the values like at you can see 2009 mein mark in 2009 market was at 8,776 value. So from marking here for next 8 years somebody is invested. So let us see how the values have come. So obviously uh, we'll check up how the after 8 years of period how the returns have been been deriving for that person if somebody is invested for 8 years. So let us go like 1, 2, 3, 4, 5, 6, 7, and 8. At the end of 8 years, that person who has invested at the value of 8,776 is deriving almost like 49% return on his investment. And similarly, if somebody started at in 2014, so what will be the return for him after 8 years? So 1, 2, 3, 4, 5, 6, 7, and 8. So at the end of 8 years, that person who has invested in 14 at the value of 16,576 index value, when the index is at 33,000 value, so that person is making 100% return on his investment. So what overall mean by representing this Excel sheet? Why do I'm representing? So if you see ki a person who has invested for 1 year, like if somebody invested in 98, it come out at 99, or someone invested in 99, come out at 2000, or somebody who's invested in 2002 and come at the 2003. Similarly on to 3 year, 5 year. So you can see ki how many times we are getting a negative returns if somebody is investing for the only 1 year, random 1 years. So we can see ki like if we see the red column, we will focus on the red columns. So 1, 2, 3, 4, 5, 6, 7, and 8. So out of these 28 years, you can see the total number of years are for investments since from 95. These are 28 years. So how many times it is positive? It is positive for 20 times. And how many times it is negative? It is negative for 8 times. So how much probability is there कि we will be getting the returns, positive returns, or how much probability is there कि how much we will be getting the negative returns? So obviously, mark index has been positive for 20 times. So out of 28 times, the probability comes at the 70% return. And at same time, if somebody has invested for 3 years, random 3 years, and let us see how many negative returns are being yielded. So 1, 2, 3, 4, 5, 6. So you can see ki like 22 times market has given positive returns out of 28 times, and 6 times it was negative. So how much probability is there? Like 80%. Almost we can say 79%, 80% probability is there. We may get our like positive returns if we are remain investor for 3 year. Similarly, if we go on the 5 year and 8 year period, so we can see in the 8 year of period, if somebody remain invested for 8 years, so you can see only two columns are representing where the returns are negative. So how the probability is increasing as the our long term holding is increasing. So the question which has arisen in the inception of our topic, why to invest in India, why early, and how much long term investments horizon should be in your mind when you are going to invest. So you can see ki in a 14-year of period, in a 10-year of period, the probability of getting positive returns also increases. From 8 to 14 years, this also increases. So your horizon should always be longer term horizon because why do we want to invest? Why do we wanna invest? Why do we want to invest? Obviously, because we have some bigger goals. Bigger goals, like if we want to plan for our higher education of higher education of childs, or say after 30 years we want to plan our pension, or say marriage, or say with a horizon of 5 to 8 years plan if somebody is at the age of 22 and he starts earning with a 5,000 rupee investment, so he can make at least a good handsome amount for, like if he is planning a car or anything. So our bigger goals can be planned by this, like higher, longer horizon periods. So overall crux of this showing this Excel sheet is ki, like if we are remain invested for long term, our probability of getting a positive returns is also increasing. But at same time, in the 1 year rolling period, what is the second thing? Ki, like 30% probability is also there ki you may get no returns, negative returns, or even your principal amount can be reduced by the original value. At same time, in the 3 year period, it is there like 20% probability is there that you may not get a good returns and you will be getting a negative risk. But at the as the horizon increases, the probability of getting the positive return also increases, and the number of rate of return is also increasing. That is a highlighting point. And what that is what similar I have shared in the S&P 500. You can see like in S&P 500 75 79, so probability is both, like in this three case study you can see in Nifty this probability is also increasing. You can see in Indian market, if somebody is investing for 3 year period, so only we can see one two times it has been getting a negative returns. In 5 year period, it two times, and 8, 10, 14 years, it is almost negligible. So for the longer horizon, you can get a higher return for your investment. So that is what all I was just wanted to share. Ki longer your horizon, longer the returns expectation from your investment. So one thing which I also would like to share you all, ki if we see ki how the Indian mutual funds penetration in, first of all, you see the current state of the Indian stock market. Like only 3% of Indian households are actively investing in stock market. 3%. You see like how the education, financial education level is very low. As this education level increases, our Indian markets are going to be increased by the value terms. Also, why one question is also there ki why we should start early. This is a very good question. कि like, why should we start early? Suppose if somebody is, we know कि the right now pensions are being withdrawn by governments, and we are all working for the private companies. Also, many people are working in a private sector, so they can plan themselves for their retirement purpose. Like if somebody is at the age of 28, one thing which I'd like to again share here, कि just you see the average age of Indian people. Today, the India ranks the number one list of countries and dependencies by population. The population density in India is 481 per kilometer. But the main point is like main median age of the Indian people is around 28 years. Suppose if the average age of the Indian people is at 28 years and somebody wants to retire after 30 years, somebody wants to retire at the age of 30 years. So after 30 years, obviously that person will be of around 58 years. So at the age of 60 years, that person must be needed a pension, regular pension of at least 25,000 or as per their need, their to run their daily household wages or per day users of money. So for your pension plan, you can make this investment, early investment in your life. So one case study I would also like to share. Okay, suppose if someone is suppose you are starting your 5,000 rupee investment per month at the for 10 years you are going to do this investment. And suppose if somebody is investing in a like normal, you don't know the equity market returns and is investing in the FDs, fixed deposits. Or there are and many tools where the interest rates yielding around 6% to 8%, 6 to 8% returns, and that person's getting a rate of 8% return in his investment. So that person who is investing for 5,000 rupees for 10 years period and getting a 8% return on his investment. So how much the value he will be getting after the 10 years? So here the one good thing is like we are investing a 5,000 rupees for how much period? For 12 months, for 10 years. So, and also for 10 years. That person in investing in 10 years of period a 6 lakh rupees. And now what will be the value after the 10 years at the 8%? That is what I want to share you all. Like if somebody is investing at the 8% return for 10 years of 5,000 rupees. So that person after the 10 years of time period with the 8% return getting a 9 lakh rupees. This is what we can say. This is a FD returns. If somebody don't know, like he don't know where should he has to invest. For case study purpose, like I've shown you like if somebody was investing in Dow Jones or index or his country's index, and he has been remained disciplined and invested for at least 10 year, 15 year, 25 year. So we are just taking a case study. Just give me a minute. Like if somebody is investing at the 5,000 rupees for 15 years, for 20 years, for 25 years, and for 30-year period. Now, that person has taken my presentation seriously and now is going to invest in the index, this country's index, where you can see in a like 28 year of period, this index has because this is a Dow Jones, it has ultimately given if somebody has invested from 95 and has been remain invested up till the December 2023. So he is getting a 7% return. So obviously Indian people will not be interested ki I am getting 7%. Yes, it is good because the US has got the interest rate never be above the value of 2%, I think. And this is the only exceptional period where the after COVID-19 people are seeing the more than 4% return in their government bond yield. And Fed rates returns. So I will I just want to make it clear for like if somebody is investing in index like Indian market index, so it has given a 12% return in the 28 period if somebody is remain invested for 28 years. And this is also been case study ki life if somebody is investing from the 2014 and so on and so forth. So interest compounded annual rate returns also differs. So let us first come on this chart, this case study why what I want to share. If somebody is investing at the 8% return with the 5,000 rupees monthly value for the 10-year period, the accumulate total investment 6 lakh and that person is getting in 9 lakh rupees in terms of FD value. FD value, you can say any in tool which is giving less than the 8% return. And at same time, somebody is getting investing 5, 15, 20, 25, 30 years. And that person is investing for like in mutual fund or equities. So these returns, I take it normally as per the Indian market, 13% return. So how the values of are going to differ? You can see a person who has remained had the horizon of longer term horizon for longer purpose of his investments. So if somebody is investing for 15-year period, so let's look at the difference. A person who has just got, got the like 5% extra return, the 9 lakh rupee value is going to change in the 27 lakh, almost three times higher than the value of FD returns. You can see I am just taking a very nominal returns of 13%, very conservative returns. Like that person is very normal. He is just only investing in an index and getting only 13% return. And that is why the value has come around 27 lakhs. At same time, if somebody has invested for 20-year period with a 30%, 13% return, and see if after 15 years here from 10 years, total amount increased by investment is 3 lakh. From 9 lakhs to 12 lakh, there is also 3 lakhs. And similarly and so forth. As the values are increasing, the investment ultimate outcome of the money is also getting increased. You can see longer the horizon, longer the returns are we are getting by changing the investment tools also. Like if one is not investing in FD, is investing in equities market, his index, his country's index. So values are also increasing. Now let us see one more case study. Ki, I thought ki like it is the 5,000 rupee value is by some salaried class person. Now see ki like if somebody is having the lower middle class income and he is investing only 3,000 rupees per month. So a person who is investing 3,000 rupees for 10-year period for 8% returns and total amount invested is 3,60,000 and person is getting 5,000, 5,48,000. At same time, if somebody has taken my presentation very seriously, just see how the 10-year difference is coming. Like for the 10-year period, if a person is getting investment for the 8% return, is 5 lakh 48, but at same time you see like if I say ki somebody has invested in the equities market and at the rate of 13% where the conservative interest rates compounded annual interest rate on his investment, that person is investing the same amount in a 10-year period, but he is getting the extra amount of what, almost 2 lakh extra amount, almost extra of 2 lakh. So let us see in 15-year period how much the returns has yielded for that 3,000 rupee investment. So you see like a very nomin a very lower class person who is consistent, who understood this concept, he is investing in this equities market with better understanding of this compounded annual interest rate, and he is having a belief in his economy. So he can also achieve a 1 crore value of target in 30 year of time horizon at the end of his retirement. So that is what the crux I was interested to share you all, ki how this 1 crore planning can be done too. So this is all, and let us come on the nifty part, because this is the Indian, our in this represents the our Indian indexes. So you can see our index has started in year 95 at the base value of 1000, and today it is at the 21,000. So if somebody invested in at the 1000 value with the 28 years of horizon, so he is getting a 12% return. Absolute returns is 28%. And also, if you'll see the rolling returns, I have already shared keys rolling returns. We are seeing the returns. See, you can see 9 times it has given negative returns, but out of 28 times, 19 times the returns are positive. So probability of 70, almost we can say 67, 70% probability is again. But at the 3 year, 5 year, and 8 year, this probability is also very increasing very high, and probability of getting a higher returns is also very possible. So overall of this presentation represents like you must invest in our economy. You must be remain invested in long term horizon, because the long term horizons can be only arrived by the long term investment. One thing which I would also like to share, eh, this is a development period where people have started choosing a government which has worked for the development kind of government. So you can see when the Modi government has came, the index was 8,000. Nifty, which is national represented by National Exchange, Stock Exchange, and today it is at 24 December to 25th December 2023. It is at 21. So if somebody started investing in that, believing by choosing a right government for the development, and he started his journey by in 2014, and today at the end of March, after the like we see for 8 year period, if somebody invested, so person who has started his journey in 2015, at the end of 8 year of period, the same person is getting 165% return investment investment. At same time, you have seen ki different tools are available which are giving 8% return and 9% return, 12% return. So see how the difference in the returns is uh, also getting increased in your investment. For someone who has invested for, like if somebody started his journey in 2013 and remain invested, the percentage of compounded annual growth is also increasing. So thank you friends for being in this whole 20 minute of representation. So I hope you all well understood this concept. Go by this video. If you did not understood, must share with your friends, families, and remain invested in this Indian economy. Also, you can compare this Excel sheet, how these last 10 years has given a good returns comparatively with US economy. Like US economy is represented 150, 270, and 326 returns, whereas the Nifty has given a higher returns in terms of 8, 10, and 14 years period. Thank you, friends. Have a great day, and must share this video, because as much you will share the video, the higher the people are going to invest in our Indian economy, and higher the returns are going to come. So thank you all, friends, and must come to Pivotn once again. Thank you. Thank you to you all.